Alright, what's up, team? This is Ruben from TGE. In today's video, I want to discuss about why the Bollinger Bands suck. Why they're not good. They're failing you as a long-term investor and what you should be using instead. Okay? Um, just to do a recap on what's happening within the group. We took a few trades today, and I'll probably be doing a recap on this example of how we took some of them. We took MSCR, got 18% on that, I believe, or 15%. We hit a trailing stop loss. I think it hit a 25% at some point. We took a bull trade today, which I'll recap that trade today, and it will actually help you visually see like what I mean by this article here. So that's pretty cool. Upstart is pretty cool overall. XSP, this was a fail. So we were like 2 out of 3. Right now, we're taking another trade on bull. We actually like Webull a lot for the upside, and I'm gonna break down how we see this, how you can actually use this, replace what I'm about to teach you with. You can replace the Bollinger Bands with what I'm about to teach you. Okay, so let's get into it here. I'm gonna move myself over here. So I said why Bollinger Bands fail long-term investors and what to use instead. Okay, Bollinger Bands are a popular tool many traders use to decide if a stock is too expensive. So it's another gauge that traders and investors use, whether to say like this is overbought because it hit the top band, or it's oversold because it hit the bottom band. And I said they look like two lines, and above and below and a moving average. And the idea is really simple, right? So if the price touches this upper band, it's probably like it's going to come back down. At least that's the theory, right? And if it touches the lower band, then it's going to go back up to this median. The middle band is this black line right here, and price can be ranging anywhere between these bands, right? Anywhere from the top and the bottom band. And so the idea is like, again, it's almost used as a mean reversion trade, right? Or for you as an investor, you're going to be like, hey, like it's at the bottom band, I should start buying. But the problem is like it's very misleading, right? Because it can ride that lower band for long periods of time, and you don't know when it's going to snap back to that median, to that middle band, or to the upper band. So, why Bollinger Bands can be dangerous for long-term investors, and this applies for. I know traders use this as well too. I used to use it a long time ago for my trading, not so much for my investment, but it doesn't really work. Okay, it's not a good gauge of like we're oversold and we're overbought. Okay, so I said, let's say you're investing in a company for the next 1 to 3 years, right? You check the Bollinger Bands and the stock touches the bottom line, and you think, hey, it's cheap now, right? Like most folks think, like most investors think, but then the stock keeps dropping. Why? Because the Bollinger Band doesn't care about why the price is moving. Okay, they just measure how far price has moved from the average. That's like driving a car by only looking at your rearview mirror. So the point is that the thing with indicators is that they look at past history, but price is always random. It's forward looking. It's based off of implied volatility. It's based off what people think it's going to be, investors and participants. Okay, here are the main problems. They're based on past data, just like I just said. Bollinger Bands use the moving average and past volatility. So past volatility as in like realized volatility. There's two different types of volatilities. There's implied volatility and then there's realized volatility. Realized volatility is always smaller than implied volatility. How bumpy the price has been, but markets move on future events like earnings, uh, rate hikes, economic shifts. They don't show big money flow. Okay, institutions and hedge funds don't trade based off of Bollinger Bands. They focus on option markets, dealer positioning, and volatility pricing. So this is more to like the true ground mechanics of the market, right? It's like what is the implied volatility? What's the expected move for a price based on its growth, based on all these other things, right? Okay, they miss hitting pressure zones. So a stock may look oversold, but if the dealers or institutions are still selling, the price will keep dropping. Bollinger Bands will not tell you that. Okay, this is the only way you know when the selling is going to stop soon is when when like the option premiums will tell you that, okay? And you cannot get that off of like past historical data, nor just a chart, okay? That's not possible. So what's better? A smarter way is use what institutions use, right? Instead of guessing when price might bounce, long-term investors need to ask what levels matter to the big players in the market. And that's where Gextron comes in. Okay, so I talk about Gextron because it does this all for you. Like you could do it yourself. I think in the last video I talked about how to do like a DIY version of expect and move. Okay, so you can do like the at the money straddle. Let me see if I can pull up that article. Um, Buying the dip as an investor, right? Okay, so you could do the expect to move at the money call premium and at the money put. You pick a specific date on the option chain and you get the at the money call ask price and the at the money put ask price and you add them, and that's going to give you a range between the top and the bottom. Okay, and typically you want to, as an investor, you want to do this every quarter. So you pick the expiration closest to the next earnings date that week up, and then that is a band. And so if we've hit the bottom of that range, then now you know that we have, based on volatility, implied volatility, it's hit the bottom expectation. It's undervalued. Okay, it always moves in cycles. All right, let's go back. Okay, gamma exposure. I'll show you what this means. So this is another way to figure out like where are the biggest levels of support and resistance. Like when do you buy? And so if we go to Webull right here, or sorry, to Gextron, I'm looking at the Webull chart right now, right? And what you have to know here is that these bars, like if you're looking at Gextron or any tool similar like this, you want to say like, where's the big bars? Gextron does it really simple. This shows you the tallest bars, and those are areas of that can be major support or resistance. Okay, but just know, let's say that price is heading towards this big bar, right? Which is strike 15 for Webull. Okay, if it's heading, let's actually pull up the chart here. If it's heading towards max reward, which is 15, you notice how it starts to stall out. It's being a level of resistance. Now, if demand is strong enough to push through this, then you want to aim for the next level, the next area of interest, which is labeled AOY here, which is 20. Okay, that's the next target. Now let's do vice versa. Let's say just like there's a max reward, there's also a max pain. Max pain represents, if depends on the context of where prices come in. If price is coming towards max pain is the biggest support wall for Webull at the moment. But as of right now, because we went above this 15 level, which is the tallest positive bar, this was once support. This was once resistance, and now it's become support. You can see here, yes, price is stalling now. It's trying to hold below it, but now it's also retesting, making it support here at the top, and it's bouncing, right? So now you know, like, okay, this is a big level of support. Now this data changes all the time because the option pricing market is dynamic. It's never static. So the thing about Gextron is that it will stay updated throughout the entire trading days. Anytime there's the market is active, it's always going to update. So you're never going to be like left clueless of like, was this still the biggest support? It's not, because it's always taking into consideration what's coming in the market as of right now from the option for Webull. All right. So gamma exposure is really important. And another thing too is knowing how market makers hedge, right? How do they behave? There's a chart here called gamma profile. Webull is a very small small cap stock. So let's just take a look at SPY. SPY is a good example here. There's another screener here on Gextron called Gamma Profile. And so gamma profile shows you these bands, right? And each line represents all the expirations put together, the next expiration, which is probably today or tomorrow, and then the next month, right? So every 30 days or so. So what it shows you here is like how each expiration and each uh, price, like when is it going to become like bullish and stable versus volatile, and there may be some downturn on a stock. So for example, SPY says here, it's labeled here gamma flip. As long as SPY can stays below 563, which as of right now May 7th is 560, it's going to be volatile. It's going to be very high swings and high, like either up or down, and we may see more downturn. Okay, it's possible. It doesn't. Market makers are not going to become bullish and stabilize the market on SPY until it gets above 563. And again, this gets updated throughout the day, right? Orders are always coming in and they're always updating. Okay, so it's important to pay attention to all these things to figure out, like, you know, is there's going to be some short term downside to it, or how's the market makers going to behave, and has it met the expected move for the week or for the quarter or for the month or whatever, or for the year. Okay, all these things. So these are all things that you want to pay attention to figure out when is a good time to buy the dip, right? As an investor, like you want to keep adding, but you don't want to add at the top all the time. If you could find the bottom, if you could use tools like Gextron to tell you, like, hey, we are at a short-term bottom, it's a good time to buy, then you buy, right? Or you can hedge as well too. Like if we hit the top, you don't have to sell, right? As a long-term investor, you're holding for many years, for more than a year, then you could just hedge. You could do a protected put, you could do like a delta neutral style. Like there's so many strategies out there. Okay. So gamma exposure, volume pressure, option flow, just like I showed you guys, hedging zones. These are all tools that you need to be using, and that these are the tools that pros use. Okay, it's not just drawing lines, and it's not just the Bollinger Bands, and it's not just the moving average. It's using the option premium and using these math models to help you give you the biggest edge, right? And that also includes fundamentals. This is all with the assumption that the stock is really healthy and it's really good. Like it's got EPS growth. It's not going to go stale. Like you want EPS growth all the time, right? So this is assuming that you have done your fundamental research as well too, and it's like this is going to be a good company for many years to come. But in the short term, I want to keep adding, but I want to add at the right spots. So you use tools like Gextron to figure out where those zones to add are going to be at. Okay. All right. So I said let's break down the key tools here. The expected move tells you how far. Okay. So this is something that again you get with Gextron. Again, you could do the DIY version, which is just get the at the money. Gextron does it a little bit different because it uses implied volatility, it uses the option premium, it takes into consideration theta, all these things that helps you just make it a lot more accurate. Okay. So I said the expected move tells you how far a stock is likely to go based on the options are priced in. Whatever the option price are based in, it's going to tell you how far stock can go. Okay, and you got to pick an expiration date. Like I said, if since you're being a long-term investor, you want to pick like the closest expiration to the next earnings. So it's calculated from the price of both the call and the put options near the current stock price. This is also called the straddle. So it's called at the money straddle, ATM straddle expected move. So this is like the DIY version. Gextron's is a little bit more tweaked, it's pretty accurate. Okay. Unlike the Bollinger Bands, which are based on past price, expected move looks forward. So using the option market to predict how much price can move by a certain date, like the end of the week or next earnings report, that's what makes expected move so powerful. Okay, because it's always forward looking. Anytime you go into an investment, it's because you're thinking about the future price. You're never concerned about the past price. Who cares about the past price? It's done, right? So you need to be using forward looking metrics, not historical data. If a stock is already near its expected for the quarter, it might slow down or reverse. That's real insight, not just a guess. Let me show you an example here before I show you how it looks. I want to show you Celsius. Celsius is a great example of this. I'm a big fan of Celsius. I love the drink. I'm not telling you to buy it, but this was the quarterly top. It's labeled as QEM. That's just for my own preference. It's just short for quarterly expected move, and that was 34.69. And yes, it did go. It did go above it, right? It almost went to 40, right? Which is cool, but it's been snapping back to this area, okay? And after the earnings, I need to actually recalculate this, and I'll do this live for you right now, at least with Gactron. Show you how it's done. Okay, so they released earnings. This was the quarterly expected move, and throughout once it hit that expected move, it kind of stayed still. It did go up a little bit, but it snapped back to the quarterly expected move. This was the move for Celsius, and that was it. So now, as a long-term investor of Celsius, I need to figure out the next quarterly expected move, and I'm going to do that right now, right here, live, so you can see. And you could do the at the money straddle method if you like. So the next earnings is August 12th. Okay, so with that said, what I'm going to do is I'm going to go to Gextron. Let's pull up Celsius. Okay, so these are my local levels. Right now we're saying max reward is 40, so I need to update that chart. Let's update that. I'm going to do this live so you can see what it looks like. We'll do this in the hourly time frame for now. Oh, I do have it there. Okay, I have it 40 there. What's the next one? 37. 37 is a key level because it's a tall bar, right? This is the things I'm talking about. Like knowing where your key levels are is really important. In case you want to hedge, and if you're going to be an active investor, you might as well hedge. I have a buddy who doesn't want to hedge. I'm like, I don't understand why. He's just like, it's a long-term investment. I was like, so what? Just hedge. You can hedge, and then you can use that extra income to add more to your long-term investment. It makes no sense, but whatever. That's just my personal opinion. 34.50. Okay, this is P-trends. This is the start of the bullish sentiment. So as long as we stay above P-trends, this is pretty good for me, right? As an investor, the next target that I have is going to be 37, and it's going to be 40. Now, with that said, let's figure out the quarterly expected move. We said August 12th. So I click over here on this little calendar icon, and it's categorized by the months. So we don't even have August yet. There's no August expiration. Okay, so we'll just get the closest nearest one. August 12th. Yeah, we'll do June 20th for now. For now, we'll do June 20th. So we'll pull up the calculator, and all I want to do is just get I'll update this as soon as we get closer. As soon as there's an August expiration. Oh, August. It's not June. June, July, August. Okay, we'll do this one then. What about September? No, July. We'll do July. If it doesn't show up, I like to get the closest one before earnings. So in this case, it would be July. So I'll do 35.34 plus the number here. There's an EM column, 731. 731. That's the expected move. You'll see the plus and minus sign here. That's the expected move as of right now to this expiration date. Okay, and I'm going to copy this number, and I'm going to go back to my chart. Here, I'm going to put myself over here, and I'm going to update this, which I like this a lot. This to me tells me that the quarterly expected top now is 42.65 for Celsius. Now, what we want to do is do the bottom. Okay, so I'm going to go back here. Go minus 731. And what I like to do once I get these numbers, we're going to go here. Let's update that one. The quarterly expected bottom is 28.03. Okay, so it didn't really move a whole lot. I also like to label these. I like to say I'll do a parentheses and I'll say plus and minus 731 when I mark this. Okay, and so what I do with my investments, and once price has reached these quarterly expected moves, or at least until it gets close, right? It doesn't have to hit it on the dot; it just has to get close. If it does get close to this area first, I will recalculate the quarterly expected bottom. Okay, I will not change this. I'll just calculate the quarterly expected bottom again. If price gets to this one first, then I will calculate the expected top again. That way, because you have to take into consideration theta. Okay, these have expirations, and as time goes by and then we get closer to expiration, the expected move shrinks. Okay, so that's why I like to recalculate as soon as we made a really big move either to the top or to the bottom. But this gives me a range from here until the next quarterly earnings. This is the top and this is the bottom. So if I want to add, instead of using the bands, the Bollinger bands, they wouldn't be able to calculate this. I would just add around this area, or if it goes to the quarterly expected top first, then I'm my hedge. Okay? You could do all kinds of strategies, but hedging would be a smart idea. All right? Okay. And just like you saw, this is what it looks like. You can in Gextron you can have the expected move for any expirations that are available. Gamma exposure. So this one's one of the most powerful tools, and this is one that the users that a lot of the users at TGE Max like a lot, because it shows you local support and resistance levels. Just like I showed you here, all I did was look for the tall bars. So in this case, 37, 40, and I marked these levels, right? This is not a very tall bar, but this is the start of a positive transition. So for me, that tells me as long as we stay above this 34.5, and just like we saw right now, actually, I think it's a good example here. We're bouncing off of this area, right on the dot, 34.5, right? Maybe a little bit under. We're bouncing. So the next area to target for the time being is 37 and then 40. Okay? And then maybe if it does get above 40, because this can be a big resistance zone based on this chart. But if it can get above it, it might stall out, but if it can get above it, maybe you'll see the 42.65. Okay? So now you know what to target, and now I know what's in the way of getting to that target. Okay? Pretty easy stuff. So by watching the gamma flips, you can find points where price is likely to slow down or reverse, which is the big bars I just showed you. And that's something that the Bollinger Bands will never be able to show you. That's why they're not good. They're not good. The thing about the option world is that it has a huge influence. It has a huge influence on the equity, on the security. And the reason for that is because the option world for equity is so great. It's active, it's growing, and market makers have to do things to hedge themselves, to protect themselves. And what they're going to do as they're providing these option contracts to participants is that they're going to buy or sell the security to protect themselves. And that's the key word. They're going to buy or sell. So you need tools to figure out where are they going to sell, or where are they likely to react to unwind their hedges and this and that. So that way you're not caught why is it falling? It's such a good company. It's not because it's not a good company. It's because market makers have to unwind their hedges, or they have to hedge themselves. So they're buying in the millions, right? Possibly in the hundreds of millions and billions, because especially institutions are dumping hundreds of millions of dollars every single day in the market. So that's why. Okay, so example of how this works in real life. Let's say you're watching NVIDIA and it just dropped 6% in a week, and the Bollinger Bands say it's oversold. But you check the Exxon, and here's what you'll see. So you'll see the expected move, right? you'll see that gamma exposure where it's likely to be more hedged or to go or possibly be resistance or support level. And then also there's a spike volume near $100. I mean, institutions were very active, so you'll see that in the option flow. So this tells you that we're near possibly a stabilized or a bounce zone, right? If we're like in negative gamma, okay, this is where market makers may start unwinding their hedges, and they must start buying. They may start buying to go back to delta neutral, right? To get rid of that negative delta. So instead of blindly buying a dip, you're entering based on real pressure points and institutional behavior. And that's the main thing, okay? You just want to buy in the big bars when we're like at the bottom, like near max pain, okay? Because it's max pain, or the quarterly expected bottom, right? Use these tools to figure out where to buy. And you can use the unusual option order screener to be like, okay, like a lot of orders are coming in for the downside here. I might want to wait and buy around this zone. Okay. Let's go back here and exit this. All right. So that's it, right? Like that's okay. So it just talks about Gextron and stuff like that. So just final thoughts, because I know it's been a long video. 26 minutes, my God. Bollinger Bands might be a fine for short. Actually, I need to change this. This is not fine. Don't use it. Do not use it. But long-term investors need more, right? You need more. You need to know where risk is concentrated, where pressure is building, and how institutions are positioned. And so Gextron gives you that edge. And so that's the whole point. My point is use math, use the DIY version if you want to, use expected move, use gamma exposure levels, use implied volatility, use the option flow screener, and then you'll know where to buy. Like where is oversold and where is overbought. Where do I need to buy the dip and where do I need to hedge my long-term investments? Cool. All right. Sorry for the long video. If you want access to Gextron, there's a 7-day free trial. It's risk-free. I'll put a couple links in the description box. If you have any questions, just put them in the comments and I will get back to you. Cool.